Welcome back to Money Moves University. I'm James Jackson III. I spent 25 years in financial services before building this curriculum, and I curated this show because money shouldn't be a privilege. Let me ask you something before we get started today. Have you ever applied for something, an apartment, a car loan, credit card, even a job, and felt like there was a conversation happening about you that you were not part of? Like someone, somewhere, had already made up their mind about you before you said a word. That feeling has a number attached to it. It's called your credit score. It follows you into every major financial decision you will ever make. And most people do not fully understand what builds it, what destroys it, or how to move it until they have already paid the price for not knowing. I have been there. I have had the score that cost me, and I have done the work to get the score that opened doors. Today, I'm going to show you how that number works and exactly what to do to make it work for you. I mentioned in the first episode that I walked out of college drowning in credit card debt. Today, I want to go a little deeper on what that actually cost me, because the debt was one thing. What it did to my credit score was entirely something different. I got overwhelmed, maxed out cards, and when you are maxed out and the bills keep coming, something eventually gives. Payments got missed, not because I forgot, because the money was just not there. And missed payments, even one, do serious damage to your credit score. Multiple missed payments over time, that credit score starts to fall fast. I got below a 600. Below 600 is not just a number. It is a door that closes on you, or more accurately, a lot of doors that stay closed while ones that do open charge you extra just for the privilege. Landlords run your credit. When your score is below 600, you either do not get the apartment or you get a large security deposit and a cosigner requirement. I have been in that conversation. Car insurance companies use your credit score in most states to determine your premium. A lower credit score means a riskier driver. A lower credit score means a higher payment every single month. For a car, you have not even financed yet, just the insurance. If you do finance a car with a sub 600 credit score, the interest is not 5 or 6% like someone with excellent credit gets. You're looking at 15, 18, sometimes 20% or higher. On a $20,000 car, that is thousands of dollars extra over the life of the loan for the same vehicle. A bad credit score is not just embarrassing, it is expensive. It taxes every financial transaction you make. What changed for me was finally getting out of the debt. And I'll talk more about that in the next episode when we get into credit cards specifically. But once I cleared the balances, I started learning how credit actually worked. Not just pay your bills, the actual mechanics, what the score is built on, what moves the needle fast. Because of that, I was able to get my score finally above 800. But that number took years to build. Not because it had to, because I did not know the rules early enough. Today, you're going to know them. Before we talk about building your score, let me make sure we all are working from the same foundation. Your credit score, the most widely used, is the FICO score, which runs from 300 to 850. Of course, the higher the number, the borrower lenders think you are. Here are the ranges. 300 to 579, poor. Most lenders will decline. Those that approve charge way high rates, the highest. 580 to 669, fairly limited approval. Higher rate, larger deposits, tougher terms. 670 to 6739, approved for most products. Rates are reasonable, but not the best. 740 to 799, very good. Strong approvals, near best rates on most products. Then 8 to 850, exceptional. Best rates, best terms, lenders compete for your business. 3 credit bureaus collect and maintain your credit data: Equifax, Experian, and TransUnion. Each one may have slightly different information, which is why your score can vary depending on which bureau a lender pulls. You are entitled to a free report from each one every year at annualcreditreport.com. No credit card required, no catch. The average American credit score in 2024 is 717. Technically good, but leaving real money on the table. Most people with a 717 score are paying higher rates than someone at 760 or above. A 43-point difference on a 30-year mortgage can cost tens of thousands of dollars over the life of the loan. The gap between where most people are and where the best rates begin is exactly what today's episode is about closing. Your FICO score is built on 5 factors. Each one carries a different weight, and understanding that weight is what tells you where to put your energy first. Factor 1, payment history, which is 35% of your score, the very first priority. Whether you pay your bills on time, every account, every month. This is the single biggest factor in your score. One missed payment can drop your score 50 to 100 points, depending on where you start. And it stays on your report for 7 years. Pay on time, every time, even the minimum before anything else. Factor 2 is credit utilization, which is 30% of your credit score. This is the second highest priority and the fastest lever you can actually pull. Utilization is how much of available credit you are using. If you have a $10,000 credit limit and carry a $7,000 balance, your utilization is 70%, and that is killing your score. The target is below 30%. Below 10% is the most ideal. This factor responds fast. Pay a balance down and your score can move within one billing cycle. Factor 3, length of credit history. This is 15% of your credit score. This is how long your accounts have actually been open. Older accounts help more. The average age of all your accounts matters. This is why closing old credit cards, even ones you do not use, can actually hurt your score. Keep old accounts open with a small, paid-off balance if possible. Factor 4, which is the credit mix, credit diversity. It's 10% of your score. Having a variety of credit types, from credit cards, installment loans, a mortgage, student loans, this healthy mix shows lenders that you can manage different kinds of credit responsibly. However, do not take on debt you don't need just to improve your mix, but understand that variety over time works in your favor. And then there's factor 5, the last one, new credit, 10% of your score. This is the recent applications for new credit. Every time you apply for a credit card or loan, a hard inquiry hits your report and can drop your score 5 to 10 points temporarily. Multiple applications in a short window signal desperation to lenders. So be strategic. Do not apply for new credit unless you need it and your score can handle the inquiry. Now, let me tell you what most people get wrong about this list. They worry about the 10% factors, the inquiries, the mix, and ignore the 65% sitting right at the top. Payment history and utilization together are almost 2/3 of your credit score. Fix those two first. Everything else is just fine-tuning. You do not need a perfect score. You need a strategy focused on the right things. All right, if you are sitting on a number you're not happy with, here is the path. And I want to be honest with you about the timeline because this is not a 30-day fix. Step 1, pull your credit report first. Go to annualcreditreport.com. All 3 bureaus. Free. Look for errors, incorrect late payments, accounts that are not yours, balances reported wrong. Dispute anything inaccurate in writing with the bureau. Errors are more common than people think, and disputing them costs nothing. Step 2, set up auto pay for the minimum on every account. Not because the minimum is your goal, it is not, but because a missed payment is catastrophic and auto pay prevents that from ever happening accidentally. Then just pay more on top of it when you can, which leads to step 3, attack utilization. Pay down balances. Start with the car closest to its limit. If you can get any car below 30% utilization, do it this month. Your score will respond in the next billing cycle. Step 4, do not close old accounts. Keep them open. Use them occasionally for a small purchase and pay it off. The history and the available credit both help you. And then, step 5. If you have no credit or very thin credit, consider a secured credit card. You deposit money as collateral, use the card for small purchases, and pay it off every month. After 6 to 12 months, you have a payment history and a credit file. Oh, I forgot. Step 6. Stop applying for new credit until the score is where you want it. Every hard inquiry is a small setback when you are rebuilding. Now, the timeline. Negative marks stay on the report for 7 years. That is real, and I've lived it. But here's what people miss. The impact of those negatives fades over time as you build positive history on top of them. A missed payment from 3 years ago with 2 years of clean payment since then hurts far less than a missed payment from last month. Most people can move their score meaningfully, like 50 to 100 points, within 12 to 18 months of consistent, focused effort on payment history and utilization. That is not forever. This is a year of intentional behavior. The score you have today is not the score you have to keep. Here's what I know to be true after 25 years in this industry. A credit score is not a verdict on your character. It is a reflection of your financial behavior over time. And behavior can change. I know that firsthand, not as a theory, but as someone who went from a below 600 credit score to above 800 and what was different on both sides of that line. The difference is not just numbers. It is access. It is options. It is the ability to say yes or no to a financial opportunity instead of having the decision made for you. All right, so as you wrap up, here's your action step for this week. Like I mentioned before, go to annualcreditreport.com and pull your free credit report. Look at every account, find the negatives, identify your utilization on every card. Then come back to the 5 factors and ask yourself, which one needs your attention first? That is the starting point. Not someday, this week. And if you know someone carrying a number they are ashamed of, someone has been avoiding this conversation because the score feels permanent, share this episode. It is not permanent. This is the conversation that starts the rebuild. And if your organization is looking for financial education that gets into these real conversations, of course, visit moneymovesuniversity.com. On our next episode, we're going to talk about credit cards, whether it's a tool or a trap, because it can be both depending on how you use it. We've talked about the score. Now we're going to talk about the instrument that builds it or breaks it faster than almost anything else in your life. And of course, I have some real personal experience with both sides of that. I'm James Jackson III. The numbers is not the finish line. It is the foundation. Keep building, keep moving, and I'll see you in the next episode.